Let's look at the 7 key things Gen X should know about retirement. 1. Budgeting is still important. Budgeting might sound basic, but if you're in or approaching retirement, it's a cornerstone of financial stability. Many Gen Xers have been earning paychecks for 40 years or more, which makes it easy to lose track of where the money goes. Once you stop earning regular income, you need a clear picture of spending habits. Here's what you do. Write out all your expenses in detail. Identify where your money goes each month and factor in irregular costs like annual insurance premiums or property taxes. If spending exceeds your predicted income in retirement, start cutting back now or find ways to generate extra income. Number 2. Retirement funds can be tapped at age 59 and a half. As pensions become a rarity, more Gen Xers rely on 401ks, IRAs, and similar accounts. Starting at age 59 and a half, you can make penalty-free withdrawals from most tax-advantaged retirement accounts. This flexibility can be a relief if you need the money early, but it also comes with serious responsibility. Withdrawing too much too soon can lead to running out of funds faster than you expect. Even though you can access your money at 59 and a half, the question is, should you? If possible, consult a financial professional to devise a drawdown plan. You'll want to take only what you need to preserve as much capital as possible for your later years. 3. Understand that taxes can and will go up in retirement. It's a common misconception that your taxes will automatically decrease once you stop working. Actually, many Gen X retirees could end up in similar or even higher tax brackets. One reason is that traditional 401k contributions are tax-deferred rather than tax-free. You get a break when you contribute, but you'll pay income tax when you withdraw, at whatever the rate is at that time. If rates go up significantly, you could find yourself facing big withdrawals with big tax bills. One strategy to mitigate this risk is to move away from tax-deferred accounts and consider Roth IRAs, or Roth 401k accounts. Another possibility is converting some traditional account funds to Roth accounts now, locking in current tax rates rather than betting on stable rates in the future. So, assess whether it's beneficial to do a partial or full Roth conversion. Keep in mind that you must pay taxes on converted funds now, so run the numbers carefully or talk with a financial planner to see if it's worthwhile. Number 4. Social Security can begin at age 62. For many, Social Security is a critical piece of the retirement income puzzle. You might be eligible for survivor benefits at age 60 if you're an unmarried widow or widower. Otherwise, 62 is the earliest you can generally claim Social Security. But there's a trade-off. If you file as soon as you turn 62, your monthly benefit is permanently reduced. That could amount to a cut of as much as a third of what you'd get if you wait until your full retirement age, which for many in Gen X is 67. If you keep working while you receive benefits early, your monthly checks could be temporarily reduced even further, depending on how much you earn above certain thresholds. So, evaluate your situation carefully before deciding when to claim Social Security. If you can afford to wait, delaying can lead to substantially bigger checks that last a lifetime. 5. Medicare won't cover all healthcare costs. Although Gen X's full retirement age is around 67, Medicare generally starts at 65. This government healthcare program offers broad coverage but still leaves gaps. You'll likely be responsible for deductibles, copays, and coinsurance. Critically, Medicare does not cover the cost of long-term care, like nursing homes, memory care, or assisted living, beyond limited, short-term stays under certain circumstances. To handle those potential expenses, some retirees purchase long-term care insurance or add a rider to a life insurance policy. Your action step? Incorporate potential healthcare costs into your retirement budget. Investigate whether a long-term care policy or life insurance with a long-term care rider is worth the investment. 6. Investment strategies may need to evolve. Gen X has lived through major stock market booms and busts, from the tech bubble of the late 1990s to the financial crisis of 2008 to more recent volatility. Many have built their wealth in the market and may prefer to keep their assets there. That can be fine, but as you get closer to retirement, you might need to reduce your exposure to risk by diversifying. One tactic is to maintain a volatility buffer. This involves reserving a portion of your savings in more stable assets, like certificates of deposit, treasury bonds, or annuities, so that if the market dips, you can temporarily draw from those stable investments instead of selling stocks at a loss. Fees are another part of the investment puzzle. So, revisit your portfolio and see if you need to adjust your asset allocation. Consider moving a portion of your funds to low-fee investment options and maintain a stable reserve so you won't be forced to cash out stocks in a down market. Number 7. Estate plans are a priority. Estate planning isn't just for the ultra-wealthy. A basic will, healthcare directives, and beneficiary designations can simplify life for your loved ones and ensure your wishes are followed. Gen Xers often created estate documents years ago, but your life may have changed substantially since then. You may have married, divorced, had children, or even grandchildren. Regularly updating wills, trusts, and beneficiary designations is essential so that if something happens to you, your assets go exactly where you intend. Out-of-date documents or incorrect designations can leave your loved ones with confusion and legal headaches at an already difficult time. Your action step? Check and update all your estate planning documents and beneficiary forms. Make sure your plans reflect your current reality, not your situation from a decade ago. We hope this breakdown has helped you see the main retirement pitfalls Gen Xers face, risks, fees, and taxes, and the critical steps to avoid them. Meanwhile, if you found this video helpful, please give it a like and subscribe to The Smart Retiree for more straightforward advice on living your best retirement.